Hi, good morning, and welcome to today's session. I'm going to be looking at covering Learning Outcome 4. This is the last learning outcome of the unit, which is Operations Design and Management. So just before we get into Learning Outcome 4, let's look at a quick recap on what we covered, in the previous learning outcome, which is Learning Outcome 3. Now, we've been following a particular pattern in this unit, which is to look at, covering some of the key terminology terms, and also then to look at, how these are related to logistics and supply chain, management. So in the last learning outcome, we understood the concepts of warehousing and logistics. And I think briefly we looked at covering things like, various theories and models of warehousing, different types of warehousing, which can be done, things like, we talked about the purpose of warehousing management in general. Then we looked at different types of warehouses, private and public warehouse. We also then looked at automated warehouse, wherein we saw one of the videos of, how robotics is now being increasingly used in Amazon, some of the other, grocery, large global retailers or, logistics providers. We looked at, also understanding, climate control warehouses, warehouses which could be termed as distribution centers. And then we looked at another video of how Amazon distribution centers look like. And, that helped us cover most of the learning outcome, with regards to learning outcome 3. Then at some stage, after understanding types of warehousing, reasons and challenges behind warehousing, we then looked at some of the common issues and problems which can occur when you look at warehousing and logistics in general, things like seasonality of demand. We looked at, inaccurate inventory. Sometimes it's difficult to find inventory if the planning of the warehouse is not being done correctly. Product identification, wherein we used an example of how technology is now being used to identify and locate products, quickly and more efficiently in a large warehousing center. Use of technology like conveyor belts and, machinery and equipment, which basically speed up or, kind of shave off time when the products are being moved from one location to the other within the warehouse. We also looked at understanding, some of the challenges that we get to see primarily in warehousing. And these challenges are addressed by things which we call the Internet of Things, IoT. And Internet of Things included things like, item level tracking. It also looked at telematics, which is basically a combination of telecommunication and, IT-based technologies to keep track of products. And then looking at other solutions, which is how most large global companies, they track, manage, and tag the assets. And sometimes, you look at your products being delivered through an e-commerce supplier, you are also getting intimations or updates with regards to the email or text message that this product is so many stops away. And all this is done through the Internet of Things. And last but not the least, in the previous learning outcome, we looked at, what was the, importance of warehousing logistics. So when we look at logistics as a term, we talk about logistics as a whole. But when we look at logistics within a warehouse is also important. And that is where we typically looked at how inventory is managed, how, it is transported from one location to the other, the importance of docking bays in large warehouses and distribution centers, which helps again, lessen the time which the product takes to move from one location, from picking, packaging and, basically distribution and dispatch. So we looked at this particular concept, and that concept is how, it is looked at in a warehouse when we decide to, when an order is received, and from the time of receiving the order to packaging, picking, then to packaging, and then to a dispatch is what most focus on when we look at the function of logistics, within a warehouse. Now, with that understanding, we're going to go into learning outcome 4 today. And in learning outcome 4, we are basically going to be looking at covering things like, some of the analytical techniques, because this is a very complex operation. And when I say it's a complex operation, because of the number of SKUs or products which are stored in a warehouse, the number of orders being received, the size and enormity of, the warehouse or the location in which there are so many different types of products and materials stored, which are to be serviced to the customer. at some stage, it requires meticulous planning, and this meticulous planning is done using some, I would say, analytical methods or tools and techniques. And in some of them, we use softwares. In some of them, as the technology has evolved, obviously there are a number of softwares which are now available, which primarily help us do this more efficiently. But in the olden days, it used to be done manually, even on paper, and then at some stage, it went on to Microsoft Excel, but with the evolution of softwares, which are softwares like Minitab, ERP packages and modules under the enterprise resource planning, and when we look at SAP in general, these softwares have made some part of the planning side of things on this a bit more easier. So materials planning, when we look at inventory management, when we look at inventory storage and how much to store, and how much is too much and how much is too less, when you are in the business of logistics and warehousing, is what we look at through the process of forecasting. So in this particular learning outcome, we're going to be looking at some of the techniques, in particular linear programming, understand what is forecasting. We look at some key critical terms like lead optimization time, network optimization, and then towards the end, what we'll also look at is understand what is some of these softwares and how these softwares are essentially going to help in what is called the planning and forecasting in terms of logistics and supply chain management. So let me just open the deck of slides that we're going to go through today. Before we get into this, what I would want to do is primarily look at going through some of the key, terms when we look at in this particular case for learning outcome 4. So let's start off with, we'll be looking at three assessment criteria in the learning outcome 4, and they would be evaluate the role of forecasting and linear programming in materials planning. We'll also look at the concepts of lead time optimization and network optimization. And last but not the least, as I mentioned, get into some understanding of, at least when you are working within this field, when you are, in this particular, say, if you work as a materials planner or you work within a logistics company, there are some of the basic bits that you are expected to understand. And these are, technology tools or softwares which help you do your work more efficiently. And if you are in specific related doing work related to forecasting, materials planning, inventory management, and obviously ordering within the warehouse for storage and redistribution of material. These are some of the software applications which will be useful to have some knowledge about in terms of their background and how they are used. We're not going to be getting into the actual uses of the software, but the idea here in this particular assessment criteria is to understand what these softwares help do, how they enable the process of forecasting, and how do they help in primarily materials management and inventory planning. So let's look at understanding the first few key terms, things like forecasting. Now, in general, when we look at forecasting, any idea, Hamza, in terms of what do you mean by the word forecasting? So when we look at, in general, the definition of the word forecast, it means to predict, or you're trying to basically look at, estimate what it would be, say, in example, the demand from the customer is. If you look at this festive season, what we are looking at is trying to understand how would the demand, of a certain product would be. So when we look at the concept of forecasting, we are looking at, in a supply chain management's point of view, what we're looking at is trying to understand how much inventory do the companies need, and what inventory and raw material they need to be able to produce and service the orders. So manufacturers in general will look at materials forecasting to ensure that they're able to produce the amount of goods which are required as against the customer orders which have been placed. So they want to always look at optimizing the usage of inventory, storage of inventories, because if there are orders being received, they need to ensure that they have the relevant raw material in the background to be able to, produce and service those orders. Now, forecast also should not fall short when a manufacturer finds out that the inventory is not there to fulfill customer orders. So if you look at the Christmas season now, you will see that generally all companies have already done adequate forecasting about a couple of months earlier, say starting just towards the end of summer, and they have forecasted and also estimated the type of demand which the customers would be bringing towards a particular type of product. Now, if they're not able to service the demand or service the orders in this case, and do not anticipate what kind of inventory is required to produce those orders, then that would lead to catastrophic losses, or maybe it will basically be a loss which the company has to bear. That means that that company will not be able to bear the cost, or make the profit. That order will be serviced by another competitor or another company, and when you look at that, that would mean a loss of business, for the company which has originally received the order. So forecasting as a process to estimate the kind of inventory requirements, materials required to be able to produce and service those customer orders is a very important part of any manufacturing production setup. If you produce too much, then you have to store inventory, and that would mean that, I'll give you a simple example here. Car manufacturers typically look at estimating and always look at forecasting the demand for a particular type of car models. Now, if they end up producing more, what tends to happen is the cars have been produced in a particular year, and when they are sold, sometimes you would see in countries the customer would say, okay, I want a 2020 registration plate, or I want a 2020 model. So in this case, if a car has been produced in, say, 2017, the customer would not be very convinced to take a delivery of that car, even if you're providing that with a new registration plate. So when they look at, materials planning, when they look at forecasting, they clearly look at forecasting to as close as accurate numbers as possible, so that when they produce those cars, they have the orders to be able to service those cars within that year. You wouldn't want to buy as a customer a car which has been produced in 2019 and then buy it in 2020. So your car registration documentation would say that the car is manufactured in September, but if you're buying it in January, you would expect that the car that you're buying has a January production date, so that when you have to look at reselling it, or look at the cost of the car from an insurance point of view and other factors, you would always want a current model. So forecasting in general, is a very important process which involves the management of inventory, raw material, procurement of raw material, and that is primarily done basis the estimate that the companies try to reach, especially the manufacturing and the production companies, to see how much customer demand is there for that product, and then accordingly they go about producing it. So this particular chart that you see on the slide shows you how forecasting as a process is undertaken. So a lot of companies do a lot of market research, they collect a lot of data, and this is done from reports, customer feedbacks, surveys, their own employees, their branches, regional offices, outlets, competitor, say for example, data. And when they collect this data, they try and plot it to look at how the demand is moving, create a graph. And then when they look at the creation of, creation from the data, when they create reports, they look at analyzing these reports to check how accurate is that. Are competitors over-reporting their data, or, is the customer demand being over-reported? They adjust the forecast, and then the process of sales, sales comes later, but the process of operation planning gets into it. That means they start looking at planning for the raw material which is required to be produced, within the factories to produce that goods or service. And then at some stage, once they know that the sale orders have been produced, then that gets into what is called, servicing the customer demand. So it's an important, process which starts off with collection and analysis of data, and then at some stage, post corrections, it gets into what is called the material planning. Now, there is an important term that we look at when we look at talking about, what is forecasting. But when we know forecasting is something which is to look at, trying to estimate or predict the demand, some sort of demand. A forecasting horizon also is a term which comes across, and this particular term talks about, the length of time that the manufacturer, the producer would actually look at in the future for their forecast to be produced. So sometimes when you look at large companies, they look at long-term planning. you look at midterm planning, and you look at short-term planning. So this is something that we've heard about. And when we talk about, forecasting horizon, here what we are looking at is basically looking at trying to understand what would be the demand or say, for example, the forecast which the manufacturer is looking at producing into the future. So the forecasting horizon could be short-term, intermediate, or mid-term, and it could be a long-term, thing that they are looking at. So when we look at understanding this, we break this down into something called the length of time into future to which the forecast is to be prepared. So a lot of material planners, a lot of forecasting which is done by material planners, they look at, forecasting if it's an established product. So if I look at, a car, sticking back to the example of a car manufacturing company, if you look at Toyota, for example, and if you look at, say, Toyota Camry, which is now an established model in the upper segment in sedan, they know that they have a regular demand which is available for these cars to be sold across, say, a number of countries. So when they look at planning inventory, when they look at, forecasting what raw materials, inventory, or what type of models would be required in which markets, they look at a forecasting horizon. That means they will look at long-term planning because it's an established model. It's a product which is well established in the market. It has competitors to also in the market. So when they look at planning, they look at three types of planning: short-term, intermediate, and long-term. And this generally tends to be done using something called forecasting horizon. So if for immediate demand or immediate orders to be serviced, that will be short-term, and short-term could be as low as 1 day to 1 year. But intermediate could be between 1 season to a couple of years, and the long-term generally tends to be 5 years. Now, if they're looking at introducing a variant of this model, or they're introducing a new attribute or a feature in this particular model, then Toyota would look at planning long-term. And long-term would mean that their supply chains will have to be adjusted, their suppliers will need to be intimated of the changes coming in the product, and those changes would allow their suppliers and partners to phase out the inventory, or at least service that side of the inventory that they've been carrying in stock for the production of cars. And then after a certain point in time, they will start building up inventory towards what the new variant is coming across, and that will be a forecasting horizon. So when a lot of these meetings tend to happen, between large organizations which are, which run the production facilities, and at some stage when they have meetings with their suppliers, third-party, agencies or partners, they always look at planning, forecast, and they use a term called forecasting horizon. And this is something which is primarily to initiate or depict planning, which could be short-term, long-term, and short-term, mid-term, and long-term. Now let's look at some of the other key areas of forecasting as well. Now there are lots of different forecasting. Forecast is a generic word or a generic term, which means to predict or to try and estimate what is going to happen. Now the whole idea of studying forecasting within supply chain and logistics management is to look at understanding three variables which actually affect most manufacturing and production facilities. So when we look at three variables under forecasting, one could be economic forecasting, economics in general, economic environment or the conditions in a particular area, country, economy. We look at technology in terms of what technological change is going to happen, and if it is going to happen, how is it going to affect the production and manufacturing of a product that the company is involved in. And then they also want to estimate what would be the demand from consumers in short term, mid term, and in the long term. So when we look at forecasting, these are the three different types of variables that we look at in particular when we talk about forecasting. So economic forecasting would be basically looking at making predictions with regards to how the GDP is, economic conditions of a particular country or a geography. So you look at rate of interest, inflation, you look at exchange rate, you look at unemployment. So basically the generic concepts of how the economy is faring, how the country is faring, how much growth is happening within the economy. Is it going to contract? Is it going to grow? Is it going to remain flat? So these kind of things are estimated in economic forecasting. Now the economic forecasting encompasses technology and demand forecasting, because if the economy is doing well, companies are bullish. In general, the atmosphere in terms of customer confidence is bullish, investor confidence is bullish, and that would mean that people would be, or manufacturers in production facilities would be on the offensive. That means they are planning aggressively to, service demand or, buy inventory and store materials, because they do generally feel that the economic conditions are stable, and that would essentially allow consumers to, buy products. This will, create demand, and that would mean that the companies would then aggressively plan towards what they are looking at for increasing production. Now, when we look at technology is basically looking at understanding how things are going to change in the future. So when we look at supply chain, and when we look at, in general, say, if there is a change which is coming in, which is going to mean that the requirement of raw material is going to change. So let's look at an example of the Apple iWatch. So when we look at the Series 1, basic things around the Apple Watch from Series 1 to Series 5, I think, which is available, there are not many changes, at least in the design and the size of the watch. So it's a 38 millimeter bezel and a 45 or 44 millimeter bezel. That means the size of the watch on your wrist has two variants. One is a smaller size, and the other is a slightly bigger size. But if you look at how the depth of the product, in terms of the casing, if I look at it in particular, has changed. The casing, in the first series was about 0.3, inches. That has reduced to 0.220 or 21 inches now. So when we look at 21 millimeters, so from 30 millimeter, it has gone to 21 millimeter. Now the size of the screen or the bezel has remained the same, but the depth in terms of the casing has reduced. So the watch has become much more efficient. The battery probably, which used to occupy a larger part in the watch, has been reduced, but it still offers the same kind of battery life, when you look at wearing the watch on your wrist for a day or so. And because of certain things like induction charging, which has now been introduced, through different mediums within the watch, and in some cases, the telecom module has also been integrated. So you have an option wherein the watch also has the, has an independent 4G, 5G connection. Now, this has enabled certain functions. Now, if this change is to be anticipated, Apple is not producing everything, but its suppliers and partners have to be now bought on board to ensure that they get these plans a couple of weeks or months in advance, because they are looking at changing, transitioning technology from a point of view of moving from Series 1 to 2, which has happened over the years, from 2 to 3, 3 to 4, and the third generation primarily started to integrate what is called the 3G or 4G connectivity. So that means your phone watch was no longer required to be synced up with the phone, but it could be used as a standalone product. And from then on, they've introduced the IP35, which is water, proofing technology. And then these are changes that they've made in technology in terms of how the product has improved. So when you look at technology forecasting, here we are looking at predicting what attributes, characteristics are going to change, which will help your suppliers and third-party agencies which are providing the raw material or making some of the components for the products are going to adapt to be able to, provide these materials to you at a time when a new product variant is introduced. So these forecasts are primarily, based to looking at, how transition of technology is happening, whether it's in terms of the equipment required to produce these watch, in terms of, the procedures or the techniques required when this product is being produced. And last but not the least, to ensure that the inventory supply chain is maintained, when the manufacturer actually decides to move this or look at bringing a new variant. Now, the third type of thing that we look at, which is primarily demand forecast, demand forecasting is basically estimating how much demand will be there from the customer for a particular product. And basis this, companies are looking at primarily finding out, how much to produce. When they look at how much production is to be done, they look at corresponding inventory in the background in terms of how much they need to store or have the raw materials available to be able to service that demand. So when we understand these three different types, of forecasting, whether we look at economic, technological, and, demand, we then get into understanding what are the different types of forecasting models. So if I am involved in materials management or materials planning, or in general work within the production planning and control department within manufacturing setup, PPC as we call it, we need to be able to have some tools and techniques to understand how forecasting can be done. Now, it is a science, but it cannot be from gut feel. It cannot be from previous data alone, or it cannot be just from what you picked up in your, working years of experience. But you need to look at basing this up on certain types of techniques which provide it the rigor which is required for the forecasting to be, accurate or correct. So when we look at models, we look at two types of models. One is subjective approach. That means you look at qualitative nature of, forecasting. That means you primarily rely on previous customer data or, the experience of people within the company who have handled this as a process over the years. And the other would be to look at an objective approach, which is quantitative or mathematical formulations. And this is what we're going to focus on here, because over the years, as the operations of companies have become global and companies' operations have expanded, what they have started to do is this side of the process is becoming automated. There is a lot of dependence on technology, softwares, and applications through which, the process of forecasting is now done. So when we look at qualitative methods in general, they require, executive sponsors. That means if there is a major change to be introduced in the facility or a production setup, or a new variant is being introduced, then an executive sponsor is to be found to kind of, okay that project. Now, this kind of change which happens within the organization normally requires why an executive, approval is required is because this is not a short-term change. This is a medium to a long-term change. This also requires an executive sponsor or an approval from the management at the top level, is because it will also involve maybe thousands, if not hundreds of thousands and millions in terms of investment, because they're going to be looking at maybe changing a production line or incorporating a major change in the production line to be able to accommodate a new variant or a new product attribute which is going to be introduced in a particular model. So I'm looking at an example of a car facility here, car manufacturing facility. So if a new variant is to be produced, this kind of a planning tends to happen about 5 to 7 years in advance, wherein production lines have to change, adaptations have to be done in terms of equipment, machinery, handling, training has to be imparted to people who will basically be working on that new model. And in some cases, that, not in some, but in the case of car manufacturing companies, if you look at it, involves millions of pounds or dollars of investment, because that would mean they will establish a new production line within the existing setup, which will produce a new variant. And that is where the executive sponsor is required. Now, we also look at something called the Delphi Method. Any idea, anybody who's heard of what is Delphi Method? So when we look at Delphi Method, basically, Delphi methods involve here a group of experts which primarily look at, understanding how they are basically experts within the organization, and these experts look at certain techniques to be able to, come up with why this change is to be required. So they bring the why and whereabouts in this particular method, and obviously in this process. And when we look at the Delphi method, basically it's a very structured method of communication to ensure that you are able to get the buy-in from all sides of, groups or people which are going to be working within that particular, say, change when it comes in. But generally, this is brought across by a panel of experts or a group of experts. So what tends to happen is you will have generally the heads of department which have got a number of years of experience. If there is a new product or a variant being introduced and this has to be done, then the heads of department of all the main departments within the production and manufacturing setup will get together. They will discuss this out, arrive at a bit of a consensus, and once this is done as a consensus, then documentation is produced. Extensive documentation is produced for each level of employees to understand why this is being done. And once that is produced, then at some stage, this is percolated down in terms of communication to various people who would then be looking at getting training, maybe face-to-face meetings. You're also looking at, looking at a lot of objections which come up against the method. And even in some cases, we will look at, employment of new resources or new manpower being inducted. Now, this is, yeah, go ahead.
That's the question, sir. Isn't it too extensive of an exercise Delphi method, and who are the experts that we assign? Are they from different departments or from a same department? And
Delphi method basically looks at bringing experts from different departments together. And in this case, in some cases, what we look at is when companies look at subjective areas of forecasting, they will also look at employing, consultants externally. So in some cases, a good example of this would be to look at when company looks at diversification, whether they are looking at, expanding a facility or they are looking at raising a capital, raising lots of capital from the market. They would then employ consultants. So you would generally see accounting firms coming in. If an example that I'm giving here is that if company is looking at raising a large amount of capital by, say, for example, issue of shares or debentures or bonds, then in terms of estimation of how much they can raise, how much can we raise from the stock market or the various options. In this case, the dependence would be on a group of experts, and they could be primarily people coming in from outside the company to give them some, what do you call it, information and how the market is generally faring.
like
But
consultant,
yeah,
marketing
and
consultant, and
yeah, consultants, yeah, and over the years, what also tends to happen is you would see that in a lot of companies, people when they have had a lot of experience, they've worked on a lot of different variants of say products and have been with the company and understand the company's processes are the ones which kind of also engage as group of experts because they have over the years come up in terms of ranks or achieved promotions and are probably managing certain processes or departments because of the range of experience that they've accumulated over the years. And this then helps them, get into that category of experts.
this is what I've observed in the companies that I've worked in.
Yeah,
I'm a demand planner as well, so whenever we are launching something new, we set up a meeting with all the departments, basically the concerned people. So is that the Delphi method that we are following?
that is indirectly the Delphi method, but there are lots of different, yeah, you're basically following that because you're looking at collating opinions, getting consensus or building
Getting sign-off
consensus.
from everyone and everyone's opinion regarding the
Correct.
market,
There are
right?
lots of tools that you would use, but obviously in this case, because this is a qualitative method, and I don't know if you can relate, but Delphi method is also used in doing research. So research side of things, when we look at the Delphi method, the tools that we use to collect in terms of data or build consensus is done normally through feedback questionnaires, customer feedback questionnaires, and they are fed back into the system wherein the experts or somebody in the background who's actually looking at collating all this data gets into when they want to look at, understanding the various types of feedback coming in from different people. So you might have an end customer giving feedback, an employee giving feedback, somebody who's the head of department giving a feedback, the board giving a feedback. But at some stage, all this is to be collated and relevant and meaningful data has to be brought out. And this is done by a group of experts who can understand what data is to be utilized, how it is related to the particular, subject, and is it relevant, is it not relevant. So some part of it is done, and that is why this is a qualitative technique. It's time consuming. It can have a bit of a variance in terms of what and how the data is interpreted, and sometimes the output, which is basically we are utilizing it for forecasting, might not be very accurate. So over the years, as I mentioned, we'll get into quantitative type of methods, but these are qualitative methods which were used earlier when and are still used in some cases. It might not be the case that it's now used in, say, most technology companies. So if I look at Facebook as an example, when they look at collating data or feedback and they introduce a major product change, if you remember a couple of years back, they introduced the timeline concept on Facebook page. So they would have relied on quantitative data, which is primarily the side of programming, how the systems become more efficient, how the data is treated, the algorithms. But on the qualitative side, they would have definitely looked at a Delphi method, which is to understand and do a pilot study or a protracted launch of this product in certain locations to see what the customers feel about and get some initial opinion and feedback from customers before introducing it globally. And they would have at some stage used the Delphi method to collect data from consumers, from the relevant product groups, within the company and outside the company, and also, from research agencies to see how this would be faring with the customers should a change like this, be introduced. Now, there are other techniques in the qualitative methods. One is the Salesforce composite. That means some part of the feedback is primarily taken from customers, but it comes across from the people who who are the face of the organization to customers. So they tend to be, people which are primarily, in the sales, business development, account management, or, people who are essentially, dealing with customers as the face of the organization. And a lot of this data also comes from, customer surveys. You generally see that if you buy a lot of products, from a particular company, or you buy a product for the company for the first time, you will generally receive a customer survey. It is a combination. It is still done on paper, but in some cases, you will receive a survey which comes through email, in some cases telephone calls. And the idea here is that, the questions are programmatically, served in such a way that at some stage they want to understand, okay, now you become a customer, you bought this product, are you looking at buying any other product? How soon would you replace a product? And sometimes some of these questions are leading questions in order for you to provide information which will help the company plan how it is going to sell and kind of manufacture its products in the future. So a typical example here would be when you look at buying a car. You're buying a car, but you've just bought a car, but you still end up doing a questionnaire or a survey at some stage which says how many years do you keep a car? How do you look at buying a car? Do you do an upgrade? Do you replace a car? Do you buy it from dealership? Do you buy it from private quote sales? Things like that. So these are questions which the company is trying to understand, to try to see if you are going to be a customer who will remain in the system, and is something that they would also want to find out, that would you be looking at buying a Toyota again, or would you be looking at buying another brand? So these questions help in basically some part of it are related to understanding whether the customer will remain with the company, whether the customer could be a repeat customer, and this in general is related to forecasting. Now let's look at some qualitative methods. Now in quantitative methods, not qualitative, quantitative methods, we will look at things like time series models. We look at some casual models. We look at also linear programming, which is one of the main models now used by companies as companies have become global, as I mentioned earlier, and also their products sell across geographies. So they're producing products in one geography, but they are being sold in different countries or different places, different cities. And that is why, when they look at forecasting, they have to utilize what is called, quantitative methods of forecasting. And that is where we look at a few models. Now, the time series models is that in this case, there is only one independent variable, which is time. So here the company is trying to analyze what would be the trend over a period of time. So whether, if we look at certain products being introduced now during the Christmas period, you will generally see that they have, the companies have done a bit of research to see that this is the trend going to be for, say, a simple product like Christmas jumper, or a sweater that you buy, or a jumper that you buy. What is the trend going to be this year? What color, what pattern, what design? And sometimes these tend to be, short term, because every year in this product category, the requirements would be slightly different. The customer's preferences would be slightly different. And that is why, in this case, trend is something they look at. It could be seasonal. So a Christmas jumper you wear probably during Christmas season only, and you wouldn't probably wear it in January or after Christmas has happened. So again, the trend tends to be seasonal. And the third is some of the cyclical factors that we look at, which influence the demand. And in these cases, the cyclical factors could be things like, sometimes you see the 60s fashion coming back again in the 80s, the 80s coming back again in the 21st century, 2000 and 2000. So when you look at these kind of things, and in terms of how, so basically the product remains the same, but the trend, the seasonality, and some of the preferences from customers tend to change, but the product remains pretty much stationary. So we have to look at, in some cases, in some product categories, you will have this completely, applied, is because the product has literally remained the same, but because of the trends, the consumer preferences, and the time of the year in which this is, it is sold in more quantities, or probably the demand for this product is more, is then looked at, from a point of view of time series model. So a lot of companies in clothing, in fashion accessories, would look at, forecasting using time series model, is because the product does not change essentially. But when I say don't take it literally, if I look at car as a model, for example, as a product, the car from the time it was introduced by Henry Ford to the car that we see today has changed, drastically. There's a total transition or a total difference in terms of what was produced then and what is available. Yes, but if I look at literally, it was a mode of transport on four wheels. It has remained the mode of transport on four wheels. But this would not be a literal comparison, because here the products have changed totally. So, but we look at, say, for example, if I look at a product like trouser, the trouser has remained pretty much the same. But literally speaking, it has remained the same, but not, if I look at not literally and look at it in real sense, the trouser has changed, because there are lots of different types now. There are, and if I look at an example of zine here, for example, what we do get to see, the product has changed, the material has changed, the way it is manufactured has changed. It now has different, segments which have been created. So you have a slim line, you have a medium fit, a parallel, lots of things have got introduced. So time series models can be applied in certain cases when we look at, production and manufacturing. But here the essence is that, the product does not change, but in some cases, the requirements, the customer preferences, and the seasonality of requirement actually looks at, actually prompts the company to look at, these kind of dependency on this kind of a model for forecasting. So here, when I look at time series, sometimes an example of this would be, if I look at, say, let's look at, say, one of the indexes. They look at FTSE, Dow Jones, or you look at any of the indexes. Now, they tend to follow this particular model of forecast, because here they're primarily dealing with, seasonality of how, shares or, stocks are traded in the market. So when we look at if the economy is bullish, if we go back to the three types of forecasting, economic boom, or the conditions in the economy are bullish. We look at, in general, demand being stable. So at some stage, you would see that this follows a time series model, because towards the start of the week, you will generally see stocks, going up. But towards the fag end of the week, when the trading ends on the Friday, you will generally see, in some cases, if it is bounced, or gone quite up, you will see that some of them taper down to what the usual levels of, trading are. So that is what we'll call the, say, from the start. When they start up, we are looking at, the share is probably rising, but at some stage when we look at the closing value, what we do get to see is that the closing values come back to more or less the overall average, and we don't see a spike or a jump happening, which is beyond what is predicted. So if I look at FTSE, just as an example, the FTSE average, let's get what is the FTSE average. So if I look at the FTSE average is about 75.82, but if you look at this in terms of some sort of forecasting across a range of, or a number of days or a number of weeks, you generally see that it is in the region of between 75.90 to about 75.73. So this follows, maybe an example of time series, because of way the stock trading starts. It maybe has a spike, then it goes, if the demand falls, it falls. But at some stage, they recover and they come up to a particular average, which is used, forecasting using, time series. Now let's look at some of the other models which are, say, for example, casual model. Now here, there are some factors other than time which are going to be helping in predicting, what is called the forecast value. So when you look at casual models, of forecasting, we are going to be looking at, say, for example, primarily putting into account some of the other variables, which would primarily be other than time. So if I say look at this particular model of forecasting, what we want to look at is that at some stage we would put, say, another variable into play. Say, apart from time, we look at putting demand in. So when we put demand in, you will generally see that if the demand is to increase, then at some stage companies would need to have the facilities to be able to ramp up production. So generally, when production and manufacturing facilities are set up, they look at some bit of modeling around other variables apart from time which are built in, and these variables tend to be things like storage of inventory. If I have to produce goods for 1 week, we generally store inventory for a week. But if I have to store inventory for up to 1.5 weeks, then there is provision and budgeting done within the facilities to be able to store that inventory. So this is to introduce, the trend, say, for example, the cyclical side of things, but the planning has to be done looking at expansion. So if the company or the facility has to expand to cater to increased demand, from the consumers, because the products are selling, they would not plan that, okay, I'm looking at planning it for 100%. They would plan, say, to 125%. So it could be for inventory storage. It could be for raw material planning. It could be to look at, appointing suppliers. So there are other variables than time, which they include at the time of, setting up that facility. They tend to follow what is called the casual model of forecasting. So here it is based on linear programming, which we are going to come to next, but it follows a regression model. That means here the idea would be to look at historical records or data to understand what is the connection between time and some of the other variables that would be looked at for producing goods. So when we look at regression models in general, casual models will follow regression mapping or regression modeling because they are dependent on historical data. So if I look at, say, a certain product, and I look at analyzing data in terms of how the product sales have happened over the last 10 years, over the last 20 years, or over, say, the last year, 2 years, and 3 years, you would generally see that companies are trying to look at understanding what could be the demand or requirement for that product basis some historical data. Now, those historical data would be, providing a spike in, say, for example, demand from consumers because of other factors than time. It could be things like, when we talk about time series model, it could be seasonal, it could be promotions which they have started, or maybe an introductory, offer which has been given in terms of, looking at, and I'll give you an example here. So when we look at the car manufacturing industry and we look at car dealerships, if you're being tracked as a customer when you bought a car from, say, Toyota, and they know the life of the car in terms of their defined life is 7 years. So what they do is, at some stage, the data which is being collected is being tracked, and at the end of a 5-year or a 7-year cycle, 3-year, 5-year, 7-year cycle, they will send you some offers, and these offers could be upgrade offers or exchange offers. So if you're looking at buying a new car, we will value your new car and put, say, a deposit of £1,500 or £2,000 or £2,500 towards the new value of the car that you're buying. Now, these kind of models, which will rely on past data, wherein they will go back to the customers, wherein the customers have bought a product earlier, but they're trying to bring them back to basically service a new order, or trying to get them to upgrade by also initiating, say, some sort of a promotional offer, would then be looking at using casual models. Is that okay? Now, let's look at one of the key concepts that we want to cover with regards to, the outcome, which is linear programming. Now, when we look at programming, linear programming is a mathematical modeling technique which is used to kind of, arrive at the optimum allocation of resources. And these could be resources which are any type of resource. It could be a manpower resource, raw material. It could be to do with, constraints or variables like time, machinery, money, which is required to put up a facility as well. So in this case, the idea is to put the requirements down, these variables down into some sort of a mathematical model which will take care of all the requirements and then come up with the requirements of what the forecasting would be for a particular, or what kind of forecasts would be generated using this. Now this is quite a powerful and a useful technique which is now used by a lot of companies, and this is used for real business situations, in real business situations, or in areas wherein you will see that linear programming is now currently being used as one of the main tools for forecasting is finance, production, sales, distribution, even in the case of human resources planning, and we look at in some cases when we look at marketing as well. So let's discuss a bit of this in terms of understanding of what is linear programming and why it has become such an important tool. Now there are some essentials of linear programming. When we look at what are the essentials, we know that the resources, are limited. So when we talk about resources, any type of resource, manpower resource, equipment, machinery, materials, we look at money, we look at raw materials in particular, every resource is limited. Now, the objective from a manufacturer's point of view is to kind of use the optimal level of resources to be able to produce maximum output. So when we look at this kind of an objective, the manufacturer is looking at putting in minimum resources to produce or get maximum output. The other important condition in linear programming is that we look at linearity. That means in some cases, if you increase labor input, you will generally see an increase in the output. I think in the earlier years of our learning, we've done equations or mathematical questions like, if 2 people do this job in 4 days, if I put 5 people, how many days will the job be done in? So when we look at linearity, that concept of if you increase certain input into certain type of resources, that will directly be proportional to increasing output in increasing output of the product. So that concept is called linearity. Let's look at homogeneity. So in homogeneous or homogeneity basically means here that in some cases the output which certain types of groups produce is identical. So if you employ certain types of people in a particular department, their skill set and knowledge is pretty much the same, and that's why you put them together in a team or in a department to work together. So when you look at buying equipment from a manufacturing setup, if you look at again a car assembly, if they buy robotics for welding and assembly of the car chassis, they would buy it from one company. They wouldn't probably look at buying this from different companies within the same factory or production line, is because when they look at things like spares, when they look at things like downtime, repairs, cost, all this has to be homogeneous. That means they have to be identical. You can't have one robotic assembly having one manufacturer, spares, costs, and downtime, and have something else in another assembly. So in some cases, it tends to be homogeneous. And one of the other variables that we look at is divisible. That means it is assumed that the resources and the products can be divided into fraction. That means what we are looking at here is that if in some cases you're looking at producing a certain amount of goods, then that would require a certain amount of resources, and those resources could be individualized or looked at attributing towards one side of product manufacturing, because each resource or each part which goes into the assembly line would essentially be considered as an individual component. So if I look at a car being produced, what we are looking at is if you are looking at producing 200 cars, you would need 800 tires. It can't be 804, it can't be 810, it can't be 900, because cars have 4 tires. And if I provision it this way, that there are 4 tires which are going to go into the assembly, then if you're producing 200 in a day, you want 800 tires. But if you're looking at one which is going to be going in as a spare wheel, then the spare wheel would contribute 5 tires. That would mean you'd need about 1,000 tires in inventory to be able to deliver or produce 200 cars out of the assembly line. So resources and products can be divided into fraction, because each of this is treated as individual component which is required in the overall assembly or production of that product as a whole. Now, what we want to understand is a bit of formation of how linear programming is done. So if you look at the formula of linear programming, mathematically there are three, parts to it. One is the objective function, the other is constraints, the third is non-negative constraints. Now, in most cases, this is for theoretical understanding because now we have lots of softwares like Skilab, Solver and Ascend, which we use for linear programming. So lots of organizations are using lots of different types of linear programming software for forecasting. But when we look at the formula of linear programming forecasting, there tends to be three different types of variables. One is objective function, which is primarily the problem which is identified and it's converted into a suitable objective. That means this is what you need to look at producing, for which you want forecasted in terms of raw material inventory, things like that. Then we look at constraints. So constraints could be basically resources. It could be raw material. It could be any type of resource. It could be money, for example. It could be labor. So these are constraints, which are the second part of the formula. And the third are constraints, but they are non-negative values. That means these are physical quantities which sometimes do not produce the same level of product. So previously I gave an example of looking at, say, you need 1,000 tires to produce 200 cars. But in some case, if they find that there are defects in one or two different components, then generally that would mean that it will not lead to the production of 200 cars, because if there were 4 tires which were dysfunctional or faulty, that means they were not suitable for integrating. Then at some stage, if the inventory storage has not included, say, a 2% or a 3% spare, then in that case, the assembly line would not be able to service 200 cars on that day, but probably 199 cars, because a couple of tires have been found faulty. So non-negative constraints tend to be physical quantities which are impossible to produce, but they generally do not include, they are generally not taken into consideration, because when they get delivery of this particular inventory from this supplier, they presume that this has been quality checked, quality assured, and it will do the requisite function that it is required to do, from a point of view of the assembly line. Now, when we put it into an equation, this is how the linear programming models equation would look like. So it will consist of 3 things, which is basically looking at, objective functions, constraints, and non-negative constraints, and that's how they are represented on, using a formula. Now, there is a handout which is there on Moodle, and if you want to look at understanding linear programming in detail from a point of view of the variables, objectives, and constraints, the idea would be to try and read this particular handout, but this is more going to be theoretical to get an understanding of how linear programming actually works, rather than having to use it practically, because for practical usage, we nowadays use softwares which will allow, if you put the constraints in, you put the non-negative constraints or variables in, and you want what the output that you want in terms of function, which is the finished product, you will get some sort of a forecasting, summary from the software, which will tell you that, okay, if you have this much raw material, this much inventory. So if you look at the cars, manufacture of cars, so each of this is variable. So when we look at manufacture of the car, if I divide this into, say, just the journal components, if I can visualize right now, you look at the chassis, you look at interior, you look at tires, you look at engine, you look at some of the attributes, which could be things like air conditioning and other upholstery and other bits which the customers have ordered, tinted glasses. These are all individual variables. So when we look at all these individual variables, you put that in, how much of inventory that you have for all these particular things, what could be the constraints. So sometimes when you go to dealership and you customize a particular model to say that, okay, I want instead of a 2-liter engine, I want a 2.4-liter turbocharged engine. And then at some stage you say, okay, I want not the white, leather, black leather sheets, but I want white. So in this case, the constraints tend to be that the production time required to produce the car would actually go on increasing, because some of these raw materials would not be stored because they are generally not ordered by customers. So 95% of the orders, just making this up as a statistics for example reasons, some part of it, 95% of the orders which the company gets are standard variants or models which they've created. So they have, say, a C variant. If I look at Mercedes as an example, You have different variants of the car, A series, the B series, the C series, the E. But within each of these series, there are lots of customizations the customer can do. So if you're looking at buying an executive class, and in the executive class, you want the back seats to be automatic reclining, the front seats to have automatic adjustments, which would be one of the variants. So here, if the customer is to order the car with the most highest type of specifications which are there, that means the turbocharged engine, the best interior, and the best tires, the widest tires, things like that, you would generally see that some part of this will fall into non-negative constraints because they are inventory which the company or does not stock, but they have to order it back to back from suppliers. So suppliers have the idea of the supply chain that this is one of the variants. And in E-Class, Mercedes, for example, has about 15 to 16 variants. But if somebody is to order a car which is the most high-spec car, and they generally see maybe 3 or 4 orders from that dealership across the year, this would be which will fall into what is called the non-negativity constraint. That means it is not something which is detrimental for the business. It is welcomed as an order, but the only thing here would be the time frame in which the car is going to be serviced is going to increase, and that would mean that the customer will have a bit of a wait time when you go in and put that order in with the dealership. So it's a configurable order, and a configurable order would mean that the time period for delivery in some cases would increase. So any questions on this so far? Right, let's move on to understanding the second assessment criteria. Now, second assessment criteria looks at understanding some of the key things, like when we look at what is lead time optimization. So we will look at some of this concept which is lead time optimization, and we'll also look at what is called network optimization from a point of view of logistics. So in this particular bit, let's look at understanding what is lead time. Now, lead time is generally, if I look at the literal definition, lead time is if you're looking at completing something, if you're looking at doing something, what is the time required to complete that task would be called lead time. So if I'm looking at, having breakfast in the morning, for example, my lead time is generally about 5 to 10 minutes. That means it's the time which I take to basically have breakfast and be up and running, or, start going to the office, things like that. So literally, as an example, if I look at this could be one such activity that you're trying to do, and that activity has a bit of a time for it to be completed, because you need to go through a series of steps, or you need to be able to complete a series of steps to achieve that particular activity or complete that activity. So lead time is the time it takes to process an order when we look at logistics and supply chain. So let's get into that side of things. So if I get an order from the customer, and the time it takes to service that order from the time you receive it on the website to the time it is actually shipped to the customer would be called lead time. Now, this is an important tool for calculating stocks, is because sometimes, and I go back to the same example of what I've given you for the car, if the customer is looking at customizing the model and ordering something which has a particular time required to secure that inventory from the supplier, that would also be looked at in the calculation of lead time, which is the delivery time to the customer. So if you go into the showroom and you pick up a car which is a standard model you like, and you are able to pretty much drive it away the same day or maybe the next day. But if you pick up a model which is not available and it needs to be manufactured, because you've chosen certain attributes which cannot be done at the dealership. Done, I mean, is integrated at the dealership. Like in our countries, sometimes you look at, if you buy a car, but what you don't do is you don't get an audio or a CD player integrated or an AC fitted, or for example, car mats and things like that. Now, some of these things which can be done at the dealership end would be done at their end. And that would mean that they would say, okay, we'll get these fitted in a day or two, and you can take delivery in 3 or 4 days. Once that has been done, we'll give you a call. So this is a time which is being taken to primarily process or service that order. Now, some part of this can be done at the dealership end, but some part of this, if it requires major changes or amendments to the car, would actually be done at the factory. And in this case, the dealership would end up taking a new order, which will be then passed to the factory, and they would then look at calculating what inventory is available, what is the stock level at this moment, and how long will it take to produce that particular car, and then be delivered to the customer. And this is what is generally, I would say, lead time. Is that okay? Now, when I look at what are the benefits of reducing the lead time, now why does the term lead time actually come in logistics and supply chain management? Because if you're looking at servicing an order, if you're looking at servicing a customer order, at some stage you are looking at reducing the time in which the order is picked up and serviced. That means delivered to the customer. If you're able to reduce time, at some stage that would mean that you're able to service more customers. Let's look at a practical example of lead time. You go to a showroom. You imagine if you're going to a showroom or an outlet, and there are a number of customer service executives which are actually servicing the customer. So let's look at an example of if you go to a shoes showroom, just as an example. You go to a shoe showroom and you're interested in buying a particular pair of shoes, but there are only 3 or 4, customer service executives which are able to, answer questions or provide you more information or, help you in actually trying out that pair of shoes before you buy. Now, if there are lots of customers in the shop and you've selected your shoe that you want to try out and you want to now get hold of a customer service executive to be able to say that, okay, I want a size 7 or you want a size 8 or whatever, and you want to try it out before you want to buy. Now, if the number of people in the store are 3 and there are 10 customers in the store, there is a bit of a wait time which gets created because they are already serving some other customers, isn't it?
Yes.
So when you look at that as an example, you generally see that if the customer has not been serviced and you've been waiting for say 10, 15 minutes, sometimes you will see generally some customers end up leaving and they go to a different store or a different shop because they say, okay, too much wait time, I'm not getting the required attention, or I'm not being serviced. So in some cases, if I look at this as an example, what has happened is if you end up leaving the shop without buying the product, that would mean that the shop has lost a sale, or they've lost a customer which had actually come in to buy a product, but because they were not able to service it in time and they were busy with other customers, that means they've lost a business. Now, if you're the owner of the shop and you sit and you're watching that, okay, there are 3 or 4 people, but during this time of the day, say between the afternoon hours, between 2 and 4, or between evening hours of 6 and 8, you get more customers. Sometimes you will see that the shop owner would actually plan to have more people working on the shop floor during these times, because they see generally a lot of customers coming in, and if they don't service that demand, it will lead to loss of business or loss of customers. So in general, this is an example of lead time, that if you're not able to service the demand or service the order or the customer in a particular point in time, then you can lose business. So the lead time as a concept, if you bloat this example up and expand it to a large global organization, which is servicing, say, thousands and hundreds and millions of orders every day, if they do not understand the concept of lead time, then look at the havoc this could reach when the company loses its customers or loses the business. So there are lots of benefits of reducing lead time, and let's look at some of the bullet points which I put. So one is reduced carrying cost, streamlined operations, improved productivity, flexibility during rapid shifts in the market. So if you look at in certain stores, store managers would primarily put people into shifts. If the store works, 10 to 12 hours a day, there are people working within the shift because it's a fast-moving environment. They're servicing a lot of customers. There are some people who are shifted from tills to the floor, from the floor to the support, from the support to the picking side of things, from picking to warehousing side of things, in order to keep them motivated in the job, keep them efficient in the job, and obviously also to try and see that they are able to work optimally at optimal efficiency while they are doing a shift of 6 hours, 8 hours, or 10 hours. So when you look at all these aspects, if we see and visualize an example of how this can be done in a small store, and you then look at expanding that example to visualize in a large facility, you would generally see that these are changes which are done primarily to reduce lead time. So the ability to outpace competitors with faster, more efficient output, that would mean if I look at Amazon and eBay today, there is a bit of a competition which they are trying to do, which imminently is happening in terms of delivery times to the customer. So why do they look at creation of warehouses? Why do they look at creation of distribution centers or facilities in which the raw materials can be stored and, you know, service to the customer is primarily to look at that if one company stocks the material and it has local availability, in that case, that means the delivery times could be shortened. So most of the material, when it is coming from manufactured in China, coming from, in developed countries, coming from the Far East, you would see that a lot of companies are looking at forecasting and demand planning or demand forecasting in general, because they know that the customers will not wait, more than a certain. So what is the optimal time for wait? If you order a product, if you don't get it in 2 or 3 days through the web, then that would mean that you will either lose the customer or the product will have to be priced in a way wherein it provides significant cost efficiencies or advantages to the customer for them to have to wait to buy the product. And I'll give you a simple example here. If you order something on Amazon and you want it next day delivery, that is called Amazon Prime. So what they've done is, in order to ensure that you are wanting the product quite quickly and you want it next day in terms of service, they would charge you a certain amount of premium. So they have certain suppliers or types of products which are listed under Amazon Prime. Their price points are about 30 to 40% higher than what you would normally see from a similar product on the Amazon store. The second thing would be that when they look at lead times, they are looking at, some of the products being delivered through standard delivery, next day delivery, or, even in some cases, they give you the option to pick up the product from the warehouse. Now, the idea there is that they are trying to provide flexibility in terms of how the product can be delivered, but this delivery is helping them shave off or reduce lead time. So quicker replenishment of stock sometimes can only happen if the servicing to the customer in terms of delivery of the stock has been done quite quickly from the time the order has been placed. And this then allows them to, look at planning inventory, looking at more stocking, looking at, introducing new products. And in some cases, this will also lead to better, cash flows. So that would mean rotation of, money from a point of view of inventory. So they bring in the inventory gets sold, the money is then available to buy more inventory. So it improves the cash flow of the organization. So I think it's not difficult to understand if you visualize a particular example of a company to see how lead times can benefit, and you look at a situation, you'll be able to correlate to that. Now, let's look at some of the strategies which companies, look at for reducing, lead time. Now, one of the things that you look at, and you must have come across this term, agile. Have you come across this term, agile? Or agile methodology in project management in particular? So in this case, when we look at agile, we look at agile as a terminology which can be used for production, which can be used for development, software development. It could be used for example, in project management. Now, basically, this is, a type of project management technique wherein you utilize, and it's a software essentially that you utilize to look at, understanding demand and what kind of solutions you can look at evolving from the demand which is being received from the customer. And this is generally done using, what is called real-time sales data. Now, in order for the company to actually sustain, a production line or a manufacturing line, they need to be able to get hold of real-time order data, data in terms of orders in the business. Now, most companies, when we look at which are web-based companies, which are doing e-commerce nowadays, or even companies which are basically having the retail stores in which they sell the product, they need to have this particular pipeline which is built on, what is called the real-time sales data to ensure that the business is able to react or provide or meet the demand depending on what the customer needs are at that point in time. So, in some cases, when you look at agile, the utilization of agile software is primarily done to look at, meeting the forecasts for a particular type of product and put that into a pipeline. So sales forecasting pipeline, which is primarily, say, when I say sales pipeline, when a sales manager looks at, the service orders for a particular month, for a particular quarter, they look at a pipeline. That I have so many customers in the pipeline that I'm speaking to. At some stage, these will be converted and they will become, from prospects, they will become customers. So if I look at an example of, say, how companies, and I'll give you an example here of, say, Tesco in the UK. Now, Tesco is a large, a retailer. They have over 6,000 stores, and across 14 countries in the European region. Now, when they look at real-time sales data in terms of how products are selling, let's look at yogurt as a category or juices as a category. They need to look at real-time data to understand how the demand is going to go up or is going to go down. So this is a product which is being sold in 6,000 plus stores on a daily basis. People are buying, say, for example, Tropicana juice, or they're buying a particular brand of yogurt, and they would then need to provide this real-time data to their production manufacturers and suppliers or partners so that they are able to provide the raw material to be able to replenish this in the stores. So in some cases, they look at dependence on understanding the real-time data, which is done through the use of softwares. And one of the softwares which is used to do this in order to reduce the lead time is the concept of agile, or the agile software, which is basically helping them understand data, which is sales data in real time. So when you till out a product and you receive a receipt, at the back end, they have a software which is providing this data onto a centralized server. And this centralized server is then helping the product planners to understand this is the number of packs of juices which are sold in each store. But over a point in time, they have a trend which is available, and they know that if I bring so much inventory in, this is going to be sold out in half a day, 2 days, and that would then help them plan inventory for that particular product by analyzing real-time sales data. Is that okay?
Yes.
Now let's look at order inventory, and how do they look at ordering inventory? Now, most product planners, sales planners, or demand planners would look at some stage historical data. They would also want to see real-time data which is coming across from categories wherein products are being stored. So imagine if you're a product manager and you sit in the head office, you are interested in finding out how the inventory is moving across various dealerships. So an example here would be, if I am a product manager for a particular type of car, which is being manufactured and sold by the company, and if I look at A series in general, we know that as a product manager, I know from historical background and data that there are about, say, 500,000 of these cars which are sold globally. But I am looking at managing data for, say, a particular country. So if I look at UK, they say probably 30,000 such cars are sold in the UK. Now, as a product manager, and how many dealerships are there? There are, say, maybe 200 dealerships. And each of this inventory across the month, distribution of the inventory across the month, across the dealership, and across, the country, is done on the basis of how often the orders are taken or are received from that dealership. Now, if I look at London market, Manchester, Birmingham, Leeds, Glasgow, Edinburgh, some of the bigger markets, what we know is that the share of these markets is higher than what is from the other cities. So as a product manager, I would look at planning and using the inventory method, which is to look at, okay, in some of these cases, because of the historical data, this particular city services these many orders across the year, and I divide that across the month. I know that maybe a city like Edinburgh sells maybe 1,500 models a month. So 1,500 across 30, you get a figure. So here, the idea would be, when they look at manufacturing, estimating demand, you're looking at estimating on the basis of the inventory which is already present in the dealerships. So if there are certain amount of cars or quantity already present, as a product planner, you would only plan for this inventory in incremental amounts, because obviously this is a higher value inventory. You don't want to have this being available in the dealership if the previous inventory is not being sold. And in order to ensure that the cost of carrying this inventory is not heavy. So when you look at dealerships storing these cars, they are insured. There is a certain amount of interest cost which is being incurred. by the dealership in terms of storage of this inventory because there's a bit of wear and tear, the model is getting old. So all that is incorporated into the overall cost of carrying inventory. So this method, when we look at, is based on the fact that the product planner or the company would try to look at implementing something like just-in-time system of inventory management, which we looked at in the first learning outcome, to try and ensure that the orders are serviced just in time, but there is adequate amount of inventory also available for the dealership to be able to do promotions, sell out these models, as and when they are doing these promotions, and the customers are able to come into the showroom, take a test drive, and also book and, if required, take or buy a model on that particular day. So when we look at lead times, there is this concept of, obviously looking at optimizing the storage and use of inventory using just in time as well, because if you say that this is something which is available with another dealership but you have not planned it locally at your end, what will happen is the customer would probably travel 20 miles to a next dealership, to buy that model on that day or, in that month or in that week, because they need it now, and this dealership has lost out on a customer even though it's in the local catchment area. So even then, the main product manager or the planner at the head office would also then speak to maybe the other dealership product planners as well, because they know exactly what car model, variant, type they are selling and what they need to store to be able to service it at an instance when they get the customers walking in. Now, lead time is also shared amongst, this data is also shared amongst their suppliers, because you want to look at an efficient supply chain. So if you can anticipate that these orders are going to be coming in, you want to provide that data well in advance to your suppliers, who are then able to, obviously stock this, or, can help reduce the times in terms of procurement of this raw material for that to be manufactured. Now, in order for the inventory management, in some cases, when we look at certain types of businesses, the automation of inventory management to be done, which includes things like demand forecasting, generation of sales report, calculating lead times. If they have to be accomplished, you have to look at relying on certain softwares which will be able to incorporate all these variables in, and these variables could be coming in from different set of organizations. So if I go back again and visualize a car manufacturer, look at the supply chain that they have in terms of talking about the people which will provide data. So let's look at quickly recapping, just to make sure that you're understanding. If you look at a car manufacturer, what car manufacturer you want to pick up? Just as an example, any name.
Toyota is good.
Okay, if you look at Toyota, can you think of what are the various places from which they will, get data, or who are the people they are, which are going to be suppliers, partners, people, customers. Let's look at naming a few who are going to be a part and parcel of their supply chain. So Toyota is the car manufacturing company. They have a production facility. Who are all the set of different people who will basically interact with them?
The dealers.
So we'll have dealers, and that's one category. We have suppliers.
The suppliers.
You have, say, banks which will provide the working capital in some cases. You have suppliers which could be partners, which are actually also. So the difference between suppliers and manufacturers would be that suppliers are primarily providing the raw material. Partners could be ones which are using that raw material to make a product, and that is then integrated into the bigger factory in the overall product. So engine might not be manufactured by Toyota himself, but Toyota would have maybe 4 or 5 partners which are working on the engine. So once the engine is produced, it goes to the second one. Once this comes into the third one. So suppliers, partners, banks, customers, dealers. What else? Who else? Logistics companies. They would be requiring different types of logistics support. Things like logistics by train, by road, by when I say train I mean rail, and even by shipping freight companies. So when we look at data coming in, and they want to look at the inventory management process, there are lots of places from which data can come in, and the data will come in different types. They will have different types of data, and that data, if they have to incorporate into one particular system to make sense of what all it is providing. So customers will be providing data like what are their preferences, what kind of budgets they have, how many times they buy that product. But suppliers would be more interested in looking at providing you the quantity, the type of inventory. Partners would be looking at getting hold of individual spare parts or individual components of the inventory and then assembling a finished product and then providing. So a supplier might be providing 20 different types of components to a partner who is then integrating it into an engine, but the output of that product is only one. So that means from that partner you're getting the engine, from a partner you're getting just the tires, but the tire supplier would essentially get rubber from the farmers. It will be some chemicals that they need, and they might have 50 parts of it which is coming in, but the finished product coming to the Toyota plant is basically a tire which will get integrated into the car or whatever it is. So when we look at automating this process, what we are trying to look at is the automation of this product would require lots of different types of variables to be incorporated into the system. And that would mean that at some stage we will look at having, say, a software, or because of technology, have sort of a software which will allow all this input to be incorporated. And at the end of the day, what we are looking at doing is we are looking at reducing to a certain extent time which is required to produce this particular inventory. Now let's look at one other concept before we look at wrapping today's session up. Let's look at network optimization. What do you mean by network optimization in logistics? Any idea?
Is it the same thing as reducing bottleneck the network?
No, maybe, but not necessarily. No. When we look at network optimization, we are looking at understanding here the concepts of costs and the benefits that it will provide. If the company is to look at reducing costs, what kind of benefits would it provide to the overall network which is involved in supply chain to provide those components, raw materials to the company. So when I look at network optimization, if I look at giving an example of sometimes we see that companies, we talk about concepts like horizontal integration and vertical integration. Have you heard of these concepts called horizontal integration and vertical integration? Yeah. So if I'm saying, have you heard about this concept of sometimes within companies, we look at that the companies are looking at horizontal integration, or when we talk about vertical integration. So when we talk about horizontal integration means that the company is looking at increasing the production of goods or services by looking at the same type of supply chain. That means they want to look at internally manufacturing everything. So if I look at car industry, Toyota, if they have to implement horizontal integration, that would mean they want to manufacture everything from tire to the engine to the chassis to the raw material. So if they have to add the finished product, that would be horizontal integration. So they want to own every type of process which will then bring it into their fold to produce a finished product. So horizontal integration sometimes also refers to a company wants to have a monopoly on whatever it is trying to service in the market. So if I look at this as a concept and now visualize what is network optimization. So if I look at horizontal process, currently Toyota might be using maybe 200 suppliers to get a lot of products which are then finally integrated into a Toyota Camry in the plant. So things like car handles, doors, lights, electrics, mechanics, engine, chassis, tires, upholstery. You look at all the things which go into a car. There might be 600, 700 different items which go into a car. But Toyota is not manufacturing everything. But in order for them to optimize the delivery and supply chain of these products coming to the factory, at some stage, this is like a network. They have a network of suppliers, right? So if you have to optimize this, what we are looking at is we are looking at optimizing the network of suppliers which Toyota as a company has to primarily provide all the raw material required to produce the the finished product or the final product, and that will be the network that it wants to optimize. So here they might be looking at optimizing things like at the production side, on the warehousing side, inventory side, transportation side, purchase side, raw material, inventory, storage side, and all this is a network, correct? So this is a series of activities, in short, which the company undertakes, but each of it has its own detailed side of working. So if I look at production is a series of activities or a network of activities under which just production happens. If I look at warehousing, there's a series of activities which leads to warehousing. And if I look at inventory management, raw material purchase, transportation, there is a lot of activities which are happening under that particular banner, and that would constitute, transportation. But if I look at these as independent departments at some stage which do and are responsible for certain types of, processes, and if I give this a name of a network, basically car manufacturing requires a network of activities, and this network of activities would include things starting from purchasing of raw material, purchasing of raw material, to having a supply chain and a partner's supply chain to be able to provide some of these semi-finished products. Then at some stage coming into the production facility, from the production facility, the final product going to warehousing. From warehousing, it is getting distributed to various dealership, and from dealership, distribution of that requires transportation and logistics and storage of inventory, which is the car, and at some stage from the dealership being sold to the customer. So this is a network of activities which is happening in order to understand, if you see from a full process of how a car is being manufactured to from a point to the car, how it is being sold to the customer. Is that okay? So when I look at network optimization, what the company is actually looking to do is primarily looking at understanding how they are going to be able to reduce costs which are involved in individual processes of distribution, inventory management, transportation, warehousing, and production. Is that okay? Is that something which is understood?
I didn't understand horizontal integration. How is that related to this?
No, horizontal integration is not related to this. I gave you an example that when we look at horizontal integration, and when we talk about concepts of horizontal and vertical integration, as an example, if Toyota was to integrate and bring everything in-house, that would mean under horizontal integration, they would be looking at producing and owning each and every aspect of production, manufacturing, sourcing, transportation, warehousing, and that would mean that they want to own the entire supply chain. That means from start to the finish, everything will happen within Toyota factories. They will produce even the tires, the engines, chassis, everything they will produce. But currently
they have better control over their network.
Correct. But currently they don't do that. So in some cases, in order to reduce costs, improve cash flows, and reduce losses and increase profits, what they look at is they look at network optimization. That means they would work very closely with the key parts of the process to manufacture the finished product. And if I visualize this as, sourcing and purchasing of raw material, we look at how it is then being produced into a final product. From the production side, it is going to warehouse for storage. From storage, it is going to be transported to dealerships, and from dealership, it is going to customers. So if they optimize each part of this network, so when I say optimize each part of this network, if I look at manufacturing as a whole, there is a supplier network, there is a manufacturer network, there is a distribution network, there is a regional distribution logistics network, and then finally it goes to where the customers are actually buying. So central owner distribution would be from the factory, it is going to a storage facility. Depending on how the orders are being released from dealers, it is going into regional distribution, which is dealerships. But these are all individual, components of the whole supply chain where Toyota is actually manufacturing or doing some sort of processing. Now, in order to save costs, what they have to do is optimize time frames or various variables which are required at each step. And this optimization, if they are able to do, that means they're able to what they're trying to do is optimize or bring efficiencies to reduce time, to reduce cost in terms of inventory, storage on these activities. And that whole process is being called as network optimization. Is that okay? So within the series of, if I look at car manufacturing as a whole, as a process, I can break it down into say 5 or 6 different types. One is sourcing and purchasing of raw materials. Once they are got, you send it to suppliers. They have suppliers and third-party suppliers who will manufacture some part of the product and then ship it to the factory. Once it's in the factory, it is being produced as an integrated product. Then from the factory, it gets shipped outside to a warehousing facility. So outside the warehousing facility, they at some stage would need to transport these cars and they will go to dealership. From dealerships, they will go into or being sold to customers. So if I break this down into 5 different types of big processes which are happening, and if I have to optimize each of the process or each of the cog of this process from the manufacturing to the sale, I'm trying to look at reducing times. Wherever I can reduce time, wherever I can reduce storage of inventory or optimize the transportation of the good, this is going to help me reduce costs and increase profits. And because this is happening at each step of the production facility, at each major step of the activity, what we are calling this as a process across the manufacturing is network optimization, which is looking at primarily reducing costs on inventory, purchase, bringing consistency into purchase, looking at maybe reducing production costs, warehousing costs, transportation costs, and towards the end, overall costs in the process is what we will call network optimization. Is that clear now? Yeah. Now, there are obviously some challenges that we get to see when we look at network optimization. There are some internal factors and external factors which contribute and provide these challenges. And at some stage, what we also want to be able to do is understand how these challenges can be overcome. Now, when we look at overcoming these challenges, what we are looking at is looking at doing some designing to optimize the network. An example here that I would want to give primarily would be to look at understanding how some of the parameters are what are the parameters which are going to be involved in network optimization, what is the time frame, and whether these parameters are tactical or strategic. So when we look at, say, a table to understand forecasting horizon. Now, forecasting horizon, if I recall, can you recall, it is short term, medium term, and long term. So when we look at forecasting horizon, we look at how many times this particular thing happens as an activity. So that is frequency. Now, when we look at planning bucket, what do we mean by planning bucket? Planning bucket is primarily when we look at, understanding whether this process happens weekly, monthly, whether this process happens, monthly or quarterly, or does this process happens yearly or, once in 2 years, 3 years, or, in say 5 years. So what is the opportunity of this planning which happens, and what is the frequency at which we need to do this planning? Now, in fast moving consumer goods, which are things like grocery and other bits that we talk about, the planning bucket is, daily. So for example, how many liters, million gallons of milk is being sold, you have to plan it daily. So they need a particular, software or something to understand that if this has to be calculated, it cannot be done manually. So the higher the cost of the inventory would mean that the frequency of this planning bucket would be, in a longer duration. So if I look at cars, normally, the models of the cars change once in 5 years. But if I look at a smaller product or a product which is a fast moving consumer good, their planning in terms of, changes, other things happens quite quickly. It could be weekly, daily, or monthly. There is a variable or a parameter called product clustering. Now that would mean how many variants do we have of that product. And then you have geographic clustering. That means, one, what are the variants, how you need to distribute that in a geography. So product would mean how do you distribute the variants of that within a particular geography. So when we look at network optimization, if I look at, going back to the example of cars, if Toyota is to sell Camry, which is one of its premium models, or Lexus, for example, they would look at product clustering and geographic clustering primarily in bigger markets. It could be London, Manchester, Birmingham, and Edinburgh, where they feel most of the variants of these products could be sold. And these products are generally fast moving in this particular city as against some of the other smaller cities in the UK. So when we look at product clustering, we are talking about the various types of variants and how they have to be distributed across an area, or in terms of the products. When we look at geographic, we are looking at it from a distribution into a particular area. So when we look at network optimization, and if we have to plan something from a point of view of reducing lead times, reducing cost in general across all the various departments of production, inventory management, transportation, warehousing, you would look at, depending on a technique called network optimization, because you're looking at optimizing cost at each and every step of the production, each and every step which is involved in the servicing of the order from the time of sourcing to the time of finished product being delivered to the customer. And these are the parameters which are to be looked at in network optimization. And then we look at operational, tactical, and strategic. So depending on time frame, we will classify them into horizon, depending on how quickly they are serviced or how quickly they change, what is the frequency. We look at that, whether the products, and in terms of the serviceability of the products, we look at the cycle from a point of view of, calendar. And then when we look at different types of products, so sometimes you use the term, you have a length and depth of products. That means you have different variants within the same product line, and you have different variants which are to be distributed across a particular geography or, a particular place, a city. And within the city, if you have 10 dealerships, you'd probably look at distributing maybe the most premium models in the area of the city wherein the demographic or the economic viability of buying those models, by the customers, the type of customers it service is higher as compared to some of the other dealerships within that city. Is that okay? So here, the idea is to understand the concept of network optimization. What are the challenges which are faced? How and what parameters kind of affect, internal and external factors affect optimization? And then what are the parameters which are involved when you look at planning network optimization from a point of view of, looking at the overall costs that the company wants to reduce or, build more profitability in each and every sector of the processes that it works in, whether it's transportation, production, warehousing, distribution, sourcing of raw material, and things like that. So with this, obviously, I will probably move to just the last bit of the learning outcome today, which is the assessment criteria 4.3. And here we need to just focus on, understanding what are the various softwares which are available primarily to understand, how they can help us in forecasting materials planning. Now, there are three in particular which are mentioned. One is Minitab. Now, Minitab is basically a statistical package, which is utilized in doing forecasting or material planning. ERP, we know, is Enterprise Resource Management, and it is there are different types of modules which are available, which the companies at some point in time when they look at resource planning, which could be any type of resource planning, whether it's materials, whether it's human resources, accounting, finance, logistics, supply chain, delivery, whatever it is, they can have different modules in that. And then when we look at SAP, which is basically, systems, production, and application, so the term has become SAP now as a company. And this, helps in data processing. When you're looking at, obviously a different type of software, which helps you in understanding how materials planning can be done. Now, in these slides, what I've put is some details about the different types of system and how these can be used for the concept of, materials planning. So when we look at material resource planning, MRP, we are looking at things like, computerized inventory control, production planning systems. We are looking at management information systems and manufacturing control systems. Now, each of these systems provide different type of output and information to the people which are using these systems. So if I look at the concept of MIS, which should be easy to correlate, would be that there are managers, supervisors in the company, and their interest is in understanding is to look at information to process and then basically make decisions. So when we look at management information system, this is a system which is capturing a lot of information from customers, partners, suppliers, but what information and what kind of reports they want to generate. The idea of having these systems is to ensure that the data then can be reported or data can be utilized, which has been fed into the system to create a structured output which will help in some sort of decision making. So when I look at inventory system and I look at computerized inventory, that means if the inventory is to fall below a quantity, then the system can trigger, you can set minimum inventory controls or minimum order quantity, and if it falls below that, the system would trigger an automatic reordering of that particular product with the supplier or with a partner, and that would mean that you will get replenishment of the inventory within the system. So similarly, some of these systems can actually be used to automate certain types of data which is required primarily to do materials planning. Now, there are loads of these different types of systems, and obviously when we look at these 4 different types, they then can be used to do a lot of different types of functions. So one is, how do we reduce inventory levels, component storages, improve shipping performance? So these are all the things that we can look at under the systems when they are deployed. Now, if I have to look at this through a basic flowchart of what is material planning, as a process, we look at that at some stage when we get orders from the customer, what is the best and the fastest way to be able to, service that order is the system. When the order is put into the, into the system, what is the fastest and the cheapest and the most efficient way to service that order would be looking at the process of material planning. So we go backward. We look at, from sales, when we get the order, you have a bit of demand forecasting. We looked at the forecasting type of initially in the first outcome. And then when we look at materials planning, we are looking at 3 type of things coming out. One is the operational plan, the requirements, and the procurement proposals. Now, once they are fed, your procurement process and the production process finally ends up, producing some inventory or the finished product, and that then is available or made available to the customers. So this side of processing, which tends to happen when we look at, the inputs being converted into output before it is shipped to the customer, would be the side of materials planning process. And when we look at materials planning process, there are various softwares now available which allow us to do this material planning. One is Minitab, Excel, and obviously Microsoft Excel, which has been used. So in smaller companies, you'll probably put all the data onto Excel workbooks. Some of these Excel workbooks have macros, so if you run that, it'll allow you to get some output in terms of charts, data, and that would allow you to essentially make some decisions. So in some of the subsequent slides, I've basically tried to explain using screenshots how some of this is automated within a particular setup, depending on whether it's a small company or a big company. Small companies would end up using Microsoft Excel. Larger companies would employ softwares like ERP, SAP, and that would allow them, because of the requirements, because of the enormity of the operations, and that would mean that they need complex softwares like ERP and SAP. So what is enterprise resource planning, which is one of the softwares which is used for materials planning, forecasting? It's a computer system that integrates application programs from all relevant departments of the company. And these departments could be sales, accounting, manufacturing, production, engineering, procurement, purchase, all the departments, data is integrated into the system. So all the systems are connected. So each department will have a different system. So if you're using accounting, you might have a system of accounting, but at some stage, if you're in human resources management department, you have their own software. But when a company looks at deploying ERP, they're going to basically deploy an enterprise level system, which will have all these different types of systems, and all these systems and the softwares within the one software will actually talk to each other. And that would mean, depending on the permissions which have been defined, this will allow the management, the users with different access to be able to generate, reports which will be utilized by them in their day-to-day, activities. So an enterprise resource planning software would have a lot of these different modules, and sometimes you'll see that the company might not deploy all the systems, but depending on the complexity and the access and the the requirement of the company, they might buy one module at one point in time, then buy another module at a later stage to integrate, and depending on that, they can build this into a full system which talks to each other. That means there is a central repository which then provides data and takes data from various channels and provides that into a single platform, which will allow managers or people to, obviously look at, generating reports, making decisions, and then looking at, the system, looking at the inventory in real-time basis. Now, there are lots of different types of enterprise resource managing, softwares, and they tend to be from SAP, Oracle, PeopleSoft, your Sage, which is primarily for accounting, but it looks at inventory management as well, JT Edwards, Microsoft Dynamics. So these are all different types of, softwares which are ERP software vendors. These companies have their own type of enterprise resource planning software, and depending on, when a company deploys, they will buy or basically go in for a test trial and then implement or buy this software. Now, some of these softwares cost in thousands of dollars, hundreds of thousands of dollars, and even in some cases millions. So if a company is to employ SAP, and assuming they buy all these different modules, you're probably looking at a couple of millions of dollars for the company to buy all the modules and integrate into the company, from a point of view of optimizing data which they would want to come onto the system. Now, there are lots of advantages of deploying a software which goes across the company and its suppliers and partners. Now, it builds obviously things like transparency, data availability is real time, so quicker decision making can happen. You can also see, increases in productivity and efficiency because it builds collaboration within teams when, when they want to get access to data. If you look at companies which are small companies, they maintain most of the data on paper. But sometimes when you need these data or reports to be able to analyze something or use it for, making some decisions, most of it is, fragmented. So an enterprise resource planning software system would essentially allow this data to be made available, in real time. Now, in some companies, you would see that this is also a requirement. If you have to become a partner or become a supplier, you need to have to be on that system. So large companies like Unilever, Nestle, you look at some of the car manufacturing companies like Toyota, they would expect their suppliers at some stage to be also on the same system, because then this would allow them access to some of the data that they need within the system, which minimizes communication, which minimizes obviously reports or details to be sent across, because they have access to the system to be able to see data, inventory, raw material type, the various information on a real-time basis. So this helps in reducing operational costs, and a lot of large companies over the years have implemented this system, not just within their own organizations, but in their suppliers, partners, and to a certain extent in the last mile connectivity, when we look at even distribution centers and warehousing, which allows people with relevant access to the systems and modules to be able to access this data in real time, that thereby reducing miscommunication or streamlining, whichever way you put it, for sharing of information within the company. Now, there are some limitations as well. When you deploy some sort of a large system like this across an organization, you require a lot of training. Now, for example, a couple of years back within the company that I worked, when I say a couple of years back, probably about a decade back, 10, 15 years back, I'd seen the implementation of enterprise resource planning, and in particular SAP within the organization, wherein the production, procurement, and the engineering side of module was integrated into Samsung. Now, that required about 3 months of training for the employees to understand how to use the software, as a product manager, I had to understand how PPC works, what kind of, applications are available within the system for me to able to look at product planning and control, doing forecasting, and then, forecasting of, say, components which were for laptops, things like how many processors would we need from Intel and AMD, what are the RAMs that you need, things like that. So that system required, we used to do all those planning on an Excel sheet, but at some point in time when the system was implemented and we were the first users, we underwent a lot of training in order to ensure that we were able to use the system quite well. So sometimes some of these, bottlenecks or limitations that we that we face could be limitations of how companies deploy these systems. So one is, if you don't do training of the staff, the cost of implementation is quite high. So we had a third-party agency or a consultant which was working with us, and they were getting paid on a daily wage rate basis to be able to sit with users, solve the problems, give them personalized training. The extent of customization. So we looked at customizing a lot of things. So some of these softwares, as you understand, are quite generic, but at some stage they need to be customized. So the customization, costs are involved. You look at connectivity. At that point in time, when we looked at connectivity, the minimum connectivity requirements in terms of bandwidth were that the whole company's operations had to come on fiber. It required 10 megabytes of connectivity so that when you were retrieving reports or data, it used to happen in real time. When you say real time, it was not that the report was downloading for an hour or was being compiled, because you're running a compiler report, and the compilation of that report would take an hour for it to run wherever you're running it from within the system. Login access, implementation time in terms of integration of a lot of modules. So there were 4 modules being integrated, and that took 12 to 18 months. So it started off with production side first, then went to finance, then went to engineering, and then finally to HR. So lots of different modules were integrated and slowly brought in line so that they made obviously working side of things more efficient for the employees, but the implementation time was 12 to 18 months. In some cases, some people underwent training, but if they weren't able to cope up with the system, there were new people recruited. So lack of expertise meant that the company had to recruit people from outside. Things like SAP consultants who could provide on-site support. So there were 2 or 3 people which were hired, and they became permanent, recruitment within the company, because there were lots of things which were coming up, and you couldn't depend on the third-party organization or consultants to always look at doing troubleshoot. And that meant we had to employ as a company some people who had prior knowledge and experience of working on SAP within a similar setup. And last but not the least, there was a lot of study which was done with the department heads, the key people within the organization, to put together what is called the requirement, or RFQ, requirement for finally a quotation that this is the system that we need, these are the requirements that we have, this is why we are implementing. And that identification of requirement itself took, a couple of months before it was even sent out to the vendors. And from that, the shortlisting process of shortlisting 3 vendors, demo of the 3 softwares, utilization of that for about 3 to 4 months as a pilot, and then finally sourcing or linking it down to just one, that this is the most easiest to use, or this is the most appropriate for us as the organization. So technology has become, in short, towards the end, what I would say is that technology has become an integral part of forecasting within the supply chain and, the logistics and supply chain, side of things, is because when we look at operations, and if the operations are at a local level, at a national level, and at an international level or global level, then companies need to depend on softwares which will help them get data in real time, speed, or hasten up decision making as a process, sharing of information, and for which you require the implementation of systems which could help bring in efficiency and increase productivity, because that would reduce let's put it this way, manual labor. But once the information has been input into the system then comes up with the variables and outputs. When the system gets the variables, the outputs, and the constraints, and what is required, then it comes up with the optimized forecasts which are required for the factories and the manufacturing facilities to produce that product. Is that okay? Now, this was a bit of a longish session today. So what we would obviously, I'm going to, if you need a copy of this recording, I'm going to try and send that, and obviously it will be available on Moodle shortly once it comes up. And if you have any questions, any queries on this, feel free to drop me an email and I'll come back to you. Now, the other thing which I just want to briefly look at with regards to this particular unit is